Good morning, good afternoon, good evening, wherever you are. We welcome you. We are standing by for a few moments to allow others to log in. But this is the high-level leaders dialogue hosted by the UN Capital Development Fund, UNDP, and the Green Climate Fund on climate resilience bonds. So give us a moment or two to have others join, and then we'll start the proceedings. Thank you. Thank you. We welcome everyone in the audience. We have some in New York at the headquarters of the UN. Hosting this conference are the government of Malawi, from where we have the pleasure to have His Excellency Vice President of Malawi, Saulos Chilima, as well as Ambassador Agnes Chimbiri Molande, the permanent representative of Malawi to the UN. This conference has also the privilege to welcome Preeti Sinha, the Executive Secretary of the UN Capital Development Fund, who is co-hosting the conference, Yannick Lemarek, who is on Zoom, Executive Director of the Global Climate Fund, also a co-host of the conference, and Akim Steiner, the Administrator of the UN Development Program, which is also co-hosting the fund. I had the honor to work there many years ago. We have also Jay Collins, Vice Chairman from Citibank, joining as a first one of the first speakers. We have on the distinguished panel that follows Dr. Charles Mwanwaja, Commissioner for Financial Sector Development from Tanzania, Antti Karhunen, the Director of Sustainable Finance for Investments and Jobs in the Economy, that works for the people from the European Union, European Commission actually, and Marie Diron, Managing Director, Sovereign Sub-Sovereign Risk from Moody's Investment Services. We will also have Ed Parker from Fitch Ratings. He is Managing Director for Sovereign and Supranational Ratings and Global Head of Research there. Ladies and gentlemen, it is imperative to make up for a lost decade of sustainable development and shrinking opportunities to avert devastating impacts of climate change. Global mean surface temperature is already higher than pre-industrial times. Without immediate large-scale reductions in greenhouse gas emissions, the goals of the Paris Agreement will be beyond reach. Transitioning to green resilient economy will require unprecedented amounts of funding, estimated variously at $100 trillion by 2050. The amounts really boggle the mind. Estimates are with 150 to 300 billion funding annually by 2030 to meet the adaptation and mitigation costs in developing countries. Access to affordable borrowing is critical for developing countries to finance their climate goals. Green bonds could be a game changer and have actually become quite significant. They can be facilitated by market access that ratings can promote, and the greenium that green bonds can provide. This year has brought challenging global economic and financial conditions, slower growth, inflationary pressures, tightening monetary policies, not to mention the war in Ukraine, which has hit emerging market debt particularly hard. Since the beginning of 2022, investors have withdrawn $14 billion from the asset class of emerging markets. However, recent outflows are less than half of what they were as a result of the COVID-19 crisis at the beginning of 2020, and valuations have reached historically attractive levels. Analysts indicate that emerging market debt is poised to deliver strong returns over the medium term, and transitioning to a green global economy provides attractive economic opportunities potentially to investors. Within this context, the objective of today's high-level dialogue is to highlight the concrete actions needed for developing countries, particularly LDCs, to leverage the opportunities that debt markets can bring to increase their access to affordable finance for climate actions. Outcomes from the dialogue will aim to take these actions forward through the multi-stakeholder initiatives that will contribute towards COP27. We'll begin with remarks from our distinguished opening speakers, followed by a panel discussion. It is now my distinct honor to introduce His Excellency, the Vice President of Malawi, Saulos Chilima, to provide a keynote address. Excellency, the floor is yours.
Thank you very much. The Executive Secretary of UN CDF, all excellencies and distinguished ladies and gentlemen. On behalf of the President of the Republic of Malawi and the current chairperson of the LDCs, President Dr. Lazarus McCarthy Chakwera, I present my compliments to the Executive Secretary of the UN CDF, Preet Sina, the entire UN CDF family, the United Nations Development Programme, and the Green Climate Fund. And I thank them in particular for co-organizing this high-level event. At this dialogue, I wear two hats. First, I represent the needs and aspirations of both the LDCs group, and second, my own home country, Malawi. It is my sincere hope that our deliberations will provoke and stimulate a call to policy action on how LDCs can leverage the use of green and climate resilience bonds to promote affordable and innovative green financing for promotion of a green environment, climate resilience, as well as sustainable development. Excellencies, ladies and gentlemen, let me start by putting matters into context by first defining our topic for today. According to the World Economic Forum, green bonds are structured financing instruments that are issued to raise capital to exclusively finance projects that have a positive environmental impact. Climate resilience bonds, on the other hand, are structured instruments that are issued to mitigate or address climate risks, with 80% of the funds raised allocated to addressing immediate near-term risks such as floods, droughts, and wildfires. In this regard, distinguished ladies and gentlemen, our dialogue today is very timely. For instance, the recent report from the Independent Panel for Climate Change, IPCC, highlighted that keeping the goal of the Paris Agreement alive to limit global warming to 1.5 degrees Celsius is now or never. Secondly, the Intergovernmental Panel on Climate Change finds that between 2010 and 2020, drought, floods, and storms killed 15 times as many people in highly vulnerable countries, particularly in Africa, which is responsible for less than 3% of global emissions than in the wealthiest countries. Similarly, scientists from the World Weather Attribution Group found that climate change fueled heavier rainfall during a series of storms that battered Southern Africa earlier this year. The region was hit by 3 cyclones and 2 tropical storms in 6 weeks. In total, more than 1 million people were affected by extreme rainfall and floods in the region, with 230 reported dead. In Malawi in particular, a state of emergency had to be declared due to extensive damage inflicted by storms in the region. All this was exacerbated by global warming. It is indeed against this background that African countries and LDCs require large-scale investments in order to address the devastating consequences of climate change and to be resilient against future occurrences. Yet here again, LDCs who have contributed to the least to climate change have the least access to affordable finance. For instance, in the year 2019-2020, the total climate finance provided, estimated at $632 billion, only 3% flowed to sub-Saharan Africa. Specifically, the total climate finance provided and mobilized by development countries or developed countries for developing countries, amounting to $79.6 billion in 2019, only $15.4 billion went to LDCs. Access to finance for adaptation equally remains extremely low. In 2019-2020, adaptation finance accounted for only 7% of the total climate finance, estimated at $53 billion US. The situation of access to finance is also even more complex in the African region in the wake of the global socioeconomic havoc wreaked by COVID-19 and the worsening fiscal situation. Fiscal space for the region has shrunk and the public finances situation has actually deteriorated. To this end, the region's fiscal deficits are growing rapidly, and as of 2020, public debt to GDP ratios had risen to 57.3% in sub-Saharan Africa and 88.7% in North Africa. The borrowing costs for LDCs have risen substantially, and countries have faced growing difficulties to obtain financing on international markets due to high external debt levels and poor credit ratings. This is one of the reasons LDCs continue to have the lowest access to affordable finance for the green and climate resilience agenda. To make matters worse, the little of the financing available to them are channeled towards social services as opposed to productive investment. The need for scaling up access to affordable green financing for the LDCs can therefore not be overemphasized. The need for scaling up access to affordable green financing for the LDCs equally cannot be overemphasized. Excellencies, distinguished ladies and gentlemen, this discussion is therefore very important because it is now imperative that action is taken to increase LDCs' access to affordable finance to invest in climate resilience and environmental management. We must, without delay, on an individual or collective basis, develop capacities to leverage the potential of green and climate resilience bonds to finance nationally determined priorities. And similarly, development partners, multilateral agencies, regional public development banks, NGOs, and the private sector must bring in their support. Capital markets have the potential to enable such investments. While domestic and regional capital markets tend to be shallow in LDCs, there are opportunities to tap into domestic savings with the green bond products. Such products can offer domestic savers best interest rates and longer-term maturities to help them save, for example, for their own children's education. It is therefore important for LDCs to develop a workable framework to help tap into international capital markets. For instance, in July last year, Benin, a least developed country, became the first African country to issue a sustainable development goal bond. This then demonstrates that it can be done and it is achievable. We may therefore need to ask what actions are required to help LDCs fully leverage the power of capital markets to implement our nationally determined contributions, our national adaptation plans, as well as our national sustainable development goal plans. The actions lie within and among ourselves. What we need is to collectively harness these. I therefore agree with the Executive Secretary of UNCDF that multi-stakeholder initiatives are needed to support LDCs realize the potential of capital markets to scale up investment in climate action, particularly as we prepare for COP27, which will take place in Sharm el-Sheikh in Egypt in November 2022. We need to begin the implementation of the Doha Plan of Action for LDCs, which was recently adopted with a simple and practical country-specific initiative that takes into account country-specific conditions to address climate change as one of the 6 priority areas. Such initiatives need to provide the following. Number 1, policy and technical support, including to help LDCs secure and improve their credit ratings. 2, support to help LDCs identify and assess a pipeline of underlying green assets. Number 3, financing instruments like guarantee funds to lower the cost of borrowing. And 4th and last, partnerships with creating and strengthening investor relationships. Excellencies and all distinguished ladies and gentlemen, in this particular dialogue, I invite all of us, that is governments, multilateral, regional public development banks, non-government organizations, and the private sector to deliberate on key policy takeaways to help us unlock the potential of green and climate resilience bonds to put LDCs on a sustainable path to the attainment of green and climate resilience. As we deliberate on our key actions to exploit the opportunities in these instruments, let us reflect on the framework upon which we will draw our own national and contextual frameworks to encourage capital flows in green bonds to our member states. It is my sincere hope that during this dialogue, our policy takeaways will be realistic and actionable, cognizance of the objectives of increased access to affordable finance. With this said, therefore, I wish us very fruitful deliberations during this important dialogue. I remain positive that when implemented, the outcomes of this dialogue will help all our countries to attain the milestone of accessing affordable finance to achieve green and climate resilience for sustainable development. I thank you for your attention.
Thank you very much. Your Excellency, the Vice President of Malawi, Saulos Chilima, you have urged us on forward with very strong statement and action plans. We appreciate that. I would like to turn now for an address by the Executive Secretary of the UN Capital Development Fund, Preeti Sinha, who will speak about the barriers to developing countries' access to capital, especially LDCs, to raise funding for green finance and actions that can be taken to address those barriers related to credit ratings for LDCs.
Thank you, Mahesh, and good morning, good afternoon, good evening, Member States, Excellencies, colleagues. Let me start by acknowledging the presence of His Excellency Vice President Chilima of Malawi. Thank you for your presence and participation. Today, the Financing for Development Forum that happens at the UN is an important platform for member state leaders to express both the financing gaps that need to be addressed and the financing approaches that countries can take, innovate, and deploy. Malawi is, of course, a crucial leader in advocating for the importance of financing for itself and for all the least developed countries, which at UNCDF we like to refer to as the frontier markets of today and the growth markets of tomorrow. So certainly those that hold the most promise at this time. Let me also acknowledge the other speakers, Akim Steiner, Administrator of UNDP, Mr. Glenn Marek, CEO of the Green Climate Fund, Mr. Collins, Dr. Moang Waja, Director Karhunen, and Ms. Diron. The full collection of speakers today, representing governments at the highest level, highly esteemed financial institutions, Mr. Collins, and leaders in the multilateral space, is a reflection of the commitment of all of us to deliver the robust levels of finance that must be needed to support effective climate action in developing countries. We often discuss the challenges that climate change represents, but this can never be overstated. In fact, it's getting worse. So let's relate to the vulnerable geographies. Climate change is already causing widespread adverse impacts The small island nations, LDCs, as we said, are adversely affected. The countries that we just said, that have contributed the least to climate change. On the other side, there's a growing green financing divide, where developing countries continue to have the least access to affordable finance, notably adaptation, which His Excellency just stated. Of the total climate financial flows spanning 2019 and 2020, Sub-Saharan Africa accounted only for 3%. Of course, any effort amongst these countries to finance effective climate change has been also countered, unfortunately, by the growing COVID-19 crisis and all that it brought. But green bonds represent a promising solution that leverages the power and potential of innovative finance. The issuances reached 523 billion in 2021 and about 1.6 trillion cumulatively over time. However, only a fraction of the developing countries are benefiting from these green debt markets. Africa's share was only 0.077, that's less than 1% of the total green bond issuance. So there are many barriers standing in the way of developing countries being able to leverage the green bonds, which we will discuss in greater detail today. These barriers that include the investment and environment, the credit ratings, the limited pipeline of bankable green labeled investments, inadequate financial instruments, and limited capacity of domestic financial systems that increase the cost of borrowing for developing countries to finance their climate needs. So all of these need to be addressed and solutions need to be found for all of them. At UNCDF, we aspire to be the UN's flagship catalytic financing agency for the countries that we serve, in particular the member states represented here. We would like to focus on two challenges related to the specific barriers of credit rating. First, securing and improving credit ratings. Attaining a credit rating is a precondition for accessing finance in the international capital markets. Yet, as we know, only 19 of the 46 least developed countries are rated by at least one of the major rating agencies. And sub-Saharan African sovereigns had their ratings fall from B+ to B on average as a result of the COVID-19 and related factors. In short, the countries are effectively shut out from global capital markets effectively as a result. Second, the importance of improving the incorporation of climate risk and investment in climate action into the credit ratings. We face a real conundrum here. As rating agencies incorporate climate risk into the ratings of many developing countries are likely to fall further, increasing further the cost of financing. Investing in climate action should improve ratings. However, such investments may come to the public debt market in these countries and become more expensive and less likely to materialize with lower ratings. Therefore, it's a conundrum. So without adequate investment in adaptation and resilience, ratings are likely to fall further, creating a downward spiral. Having said all of that, I would like to use my closing remarks to say we need key actions to address these credit rating challenges. Such actions include strengthening government capacity on credit rating process, carrying out a prospective assessment to understand what the ratings may be, diagnosis and advising governments on steps to improve ratings over time, and increased engagement between governments and credit rating agencies to improve understanding of government policies and investments in climate adaptation and resilience. Here at UNCDF, we are working with most of our partners, including UNDP, to support such actions. For example, we are supporting a local water and sanitation authority in Tanzania to structure a $23 million green bond on the domestic capital market related to the water sector, the water municipality. We are further supporting the government of Fiji to issue the first blue bond. Working with our partners to scale up such support to developing countries is a priority for all of us here at the UN as we move towards COP27 and implementation of the Doha Action Plan. I will close by saying what I often say. We should all make an endeavor that capital works for humanity and not vice versa. This requires a willingness to take risks, an ethos of innovation, a commitment that is sustainable. I'm confident that all of us here share these traits. I look forward to the future, and please see myself and UNCDF as your partner in this. Thank you.
Thank you very much, Preeti. I think you ended in a good mantra. Capital for human development, not the other way around. Thank you very much for your remarks and for the support that you're extending to LDCs to move forward on capital market access through ratings or otherwise. I'd like to now introduce Yannick Lemarek, Executive Director of the Global Capital Fund, also a co-sponsor of the conference, who will speak about the role of credit enhancement in reducing and segmenting risks. Some would call this the process of de-risking, but it is really more about identifying, allocating, after segmenting them all the risks so that investors can come in. He will talk about green bond issuance and the importance of domestic financial institutions in scaling up green bonds. Please, Yannick.
Thank you very much, Mahesh. Excellencies, distinguished guests, distinguished colleagues, dear friends, thank you for the opportunity to speak with you today. As the world's largest climate fund, the Green Climate Fund brings together players from across the public and private sectors to catalyze climate finance at scale and create new green markets. Markets that work for developing nations, not against them. Since our first project was approved in 2015, our portfolio has grown to over $10 billion, over $37 billion in total assets under management with co-financing. We now have 192 projects approved in 128 developing countries. 30% of our resources are invested in LDCs. The pandemic has magnified the SDG financing gap in developing countries by simultaneously increasing financing needs and decreasing availability of resources. This gap was estimated to $3.7 trillion in 2020. Green, climate resilient, social sustainability and sustainability-linked bonds represent a new asset class that has gained traction over the past few years across developed markets and that can help fill the SDG financing gap. Even through green bonds grew by almost $600 billion in 2021, they still make just a fraction of the bond market. As climate change effects are felt, investors, as mentioned by Betty, are likely to become increasingly concerned about lending to vulnerable countries. A shift toward green bonds, climate resilient bonds, issuance aimed at funding the climate transition for sovereign issuers could also contribute to mitigate such perception risks by enabling government to assert their political commitment to fight against climate change. However, the size of this market remains limited in developing countries. As already mentioned by Preti, Africa accounted for 0.077% of the global green bond markets in 2021. As mentioned by His Excellency, the Vice President of Malawi, those that are at the forefront of climate change continue to have the least access to climate finance to reduce its devastating impacts. The market for green bonds is hampered by several barriers in developing countries, especially LDCs and NDCs. Adequate market infrastructure is needed to provide the foundation for capital markets depth and liquidity. These include exchanges and trading platforms, clearing houses, credit rating assessment, custodian and fiduciaries, without which bond markets will be difficult to scale. Furthermore, supporting local public development and commercial banks in the issuance of green bonds in the form of green bond training, screening of portfolio, advising on green bond frameworks, and providing clarity about the role of green bond verifiers is critical to accelerate the issuance of green bonds. Also, there are around 260 public development banks operating in developing countries. Less than a quarter can access the international capital markets to capitalize their operations. GCF assists developing countries in removing the different sets of barriers. For example, GCF has supported, through its grant-based readiness program, the effort of the government of Jamaica to set up a Caribbean green bond listing on the Jamaica Stock Exchange, enabling it to list green bonds through a dedicated facility. Several of our projects are also supporting the legal and financial structuring of green bonds and provide credit enhancement mechanisms to improve their credit rating. For instance, GCF partners with the Asian Development Bank to support the ASEAN Catalytic Green Finance Facility. The facility was designed as the first green recovery program for Southeast Asia, providing a platform to kickstart low-emission investment to support economic recovery following the COVID-19 pandemic. It will assist in developing and de-risking a pipeline of priority green infrastructure. The anchor investment of $300 million from GCF will leverage over $3.3 billion from the Asian Development Bank and other public co-financiers. In turn, these public funds will mobilize substantial additional private capital flows through green bonds, hybrid public-private partnership, and other innovative financing models. As another example, in partnership with the Inter-American Development Bank and several local public development banks, GCF is also supporting the new Amazon Bioeconomy Fund in 6 Amazon countries. The fund aims to reduce the impacts of climate change and greenhouse gas emissions and increase climate resilience in the region. The $600 million programs will include $279 million of GCF investment and will encourage private investment in 6 key areas of the bioeconomy, with a mix of financial instruments, including green bonds, to de-risk eco-businesses in the Amazon. GCF funding under the bond component of the Amazon Fund will notably be used to finance advisory services on how to effectively include bio-businesses in thematic bond issuance, as well as how to deploy credit guarantee for green bonds issued by public development entities. Finally, GCF is currently exploring, through a project preparation grant, the possibility of establishing a green guarantee company that will be dedicated to helping developing countries mobilize climate finance from international capital markets. The access to credits of an individual climate project is capped, usually at the level of the credit rating of the country in which it is to take place. Even if a project could reasonably be rated BBB, if the country is rated BB, then bonds from this project will most likely be also rated BB. GCF will make an equity investment in the company, in this green guarantee company, which will then use its credit rating to provide guarantees to green bonds and loans, which enable developing countries to meet their climate adaptation and mitigation objectives. The guarantee will enhance their credit rating, enabling the credit rating of this investment, enabling them to exceed their country rating and access capital markets at lower cost. Guarantees are only one type of credit enhancement mechanism. In addition to guarantees, GCF and its partners will continue to explore a range of dedicated credit enhancement mechanisms to facilitate access to capital market for the most vulnerable countries, in particular LDCs and SEEDs. I would like to congratulate all the agencies that are participating in this event for this timely dialogue, and you can count on us for following up on these recommendations. Thank you very much for your attention.
Yannick, thank you very much. That is very impressive presentation, Yannick, that talks about leverage that Credit Enhancement can provide and has provided, is providing for ASEAN countries through the ADB assistance that you are fostering, 11 times leverage as I count, and also leverage for Amazon countries with the IADB. We hope we can do something in Africa with the partners in like ADB and perhaps others. So Green Climate Fund is doing impressive things. Thank you very much, Yannick, for bringing that to the attention of the audience. I'd like to turn now to our next speaker, Jay Collins, Vice Chairman of Banking, Capital Markets and Advisory Services at Citibank, who will speak about how to increase investor appetite for green bonds from developing countries. I hope he addresses in part the segmentation and allocation of risk, of which you essentially spoke, Yannick. Thank you very much. Jay, are you there?
Yes, I am. Can you hear me okay? Can you hear me? I just wanted to make sure you can hear me okay.
Yes, very well. Yes.
Okay, perfect. Thank you. So, first of all, let me start by saying thank you for having me. And most importantly, I would be remiss in saying, in not discussing a little bit the current market environments, because I think it's critical context for what we're facing. Having just spent the last week at the IMF in Washington, I was asked, what's the elephant in the room? And my answer to that is there are many elephants, and they're all moving. In fact, they're trampling on confidence of the markets right now. We have the war. Yes, that's one. We have food shocks and a food crisis. We have commodities, oil, gas, and we, of course, have an inflationary problem where we're likely to see extraordinary moves in the federal fund rates. I have never in my career, and quite frankly, markets have not seen the degree of monetary normalization that is about to take place. It is inconceivable to us that you can move the federal funds rate and have quantitative tightening of the Federal Reserve without interest rate differentials that drive capital flows away from the emerging markets and drive the dollar stronger. Of course, we have to see what happens to commodity prices during this period, but we are likely entering into a market that is concerned about stagflation, but particularly concerned about inflation. I say that because as we seek to fund development, as we seek to fund climate finance going into COP, we have to remember that the wind is in our face. In fact, we have a storm that's emerging and coming. And what happens traditionally under market duress is that it gets more difficult to fund higher risk propositions, particularly the emerging markets, particularly the double B and single B space. It also, very importantly, in every crisis I've lived through, beginning with the Mexico peso crisis, the market wants simple and clean. Simple, and by clean, I don't mean green, I mean vanilla. When ministers in the last week said, let's talk, I talk about climate finance, what we have to do for COP, they say, stop. Just talk me through how I get through this year, plain and simple. How will I survive this storm? All the complexity of structuring toward SDGs and climate is very nice, but I'm looking at this year ahead, and it's not going to be easy. Now, so that is the context that we just have to realize. Let me turn now to sustainability bonds and the sustainable bond markets. We can't possibly fund the size of capital that you all are laying out for the needs of sustainability and climate without the capital markets. And the capital markets now have, as a positive, $35 trillion of ESG linkages in large institutions that have committed to an ESG pathway. We also have the Net Zero Asset Owners Alliance that have committed to $5 trillion. We have quite a staggering amount of money that's already been invested in sustainable development bonds, be they use of proceeds or linked. There's already $2 trillion outstanding. And as others said, I won't repeat the numbers, that's growing. It's great news that the sustainability linked bond format, which links the bond market to KPIs, is also growing. It's 87% environmental at this point. And we also have seen a certain amount of greenium, meaning that you can have a 0.8 new issue concession on a green or theme bond versus a typical, say, 6.6%, 6.6 basis point conventional new issue concession. And you also tend to see more oversubscription, meaning more demand in green or theme versus the clean format. But the greeniums are not enough. The greeniums are just pure and simple. They're not concessional. So why is that? You have all this money that's committed to, from GFANs to broad-based ESG investors. Most of them have fiduciary responsibility and mandates that don't allow them to go into the sub-investment grade zone. So we hear these huge numbers, and we're all very frustrated about why don't we see them? Yes, we need to fix capital markets in many of these countries. We need to get them rated. We need better transparency and similitude around all of the ratings of ESG. And so there are a lot of mechanical things we need to do. But the truth is most of this money is stuck in investment grade land. So we can do a couple things, and here are some of the positives. First of all, we do have to scale with speed with a certain amount of simplicity, and that's lacking. Most of what we do in the blended finance space is highly complex. It's turnkey, just like, it's bespoke, meaning every transaction is structured separately. And that just means that we get wonderful transactions like Citi just did with the World Bank for the Rhino bond, or we get a Belize transaction, which is a fantastic debt for sustainability swap. But these transactions won't get us to the trillions of dollars that we need. Now, in this market that will increasingly be under duress, what can we do? Well, one is partial guarantees in the bond market just simply don't work. We've seen that. We need to be able to guarantee a certain amount of transactions in the capital market that get up into the investment grade space, right? You're going to credit enhance them, like was talked about earlier, to investment grade. That's very capital intensive. But we need to do what we need to do. I, for a long time, have been calling for the MDBs to notch down on their rating. No one likes to hear that. It seems to be more acceptable now. I think we have to be prudent, careful, and thoughtful in terms of how and when we implement that. But it's been very clear now that the MDBs have used their capital, and COVID has stressed their capital. And if we're going to get more capital to do the kinds of guarantees the world need, then taking some incremental cost of their funding in order to mobilize multiples more needs serious analysis. So credit enhancing to investment grade can't be done for everywhere, but what we can do, we should be doing. Second, I believe in a concept called, and it's just my terminology of what's happening and what I think we should do more of, outcome bundling. And simply put, outcome bundling means that we should take the complexities that the loan market can deal with to create extraordinary concessionality. And we should link it very clearly to the bond market. And there are 3 points there very important. One is that we should have the same linkage, the same KPI. Let's take the 1.5 degree target and put it into NDCs more rigorously. Let's take a very clear emission pathway. Let's have it in the loan product, and let's link it and use the same one for the sustainability linked bond product. Second, let's put the entire back end that's necessary to do both together, so that things like verification, the oversight, the creation of that linkage and KPI is done once, and for both. And third, and most importantly, to get a blended lower cost of funding for development and for climate. it is unlikely at this point to come out of the bond market alone. And therefore, we have toolkit in the loan market that is phenomenal. We have now not just concessional loans, we have guarantees and wraps that can be used and can be used at speed. We have NGOs that are now prepared to structure and fund, whether it's, think of NGOs as being willing to put grant layer money in. So on top of ODAs, on top of development bank equity, we have a low IRR equity layer or a grant layer of loss absorption capability that can be put into those loans. This concept has been called since Addis Ababa blending. It's best done with at scale in the loan market, and we can now structure in carbon credits into that, which also looks and acts like equity or cash in the structure. But we should be structuring with speed to that into the loan product as best we can, and then have the outcomes drive the bond market. It is fundamentally a mistake, and I have been against it since day one of the SLB market, to put step ups into weak credit economies in the bond market, right? If things are going wrong and a sovereign or a corporate cannot achieve in a single B country an outcome, to step up their coupon does not seem to make sense to me. So the carrots and sticks that we use, the incentive structures that are used in the bond market should be carefully crafted hand in hand with the official community, primarily, not alone, but primarily in the loan market. And we create those pari passu, aligned, parallel, tied, linked, whatever you want to call it, to whatever those outcomes are in the bond market. And we try and do so with more scale and with more speed. I know I've thrown a lot of complexity at you. I wanted to give you some real meat to wrestle with. These are complex times, these are complex challenges, and I thank you so much for your time and for listening.
Okay, thank you very much. That was absolutely brilliant. I think that you've taken brought a reality test to the discussion, talking about how to scale up in the capital markets and in the loan markets with mechanisms that you have mentioned that would allow segmentation and bundling of risks, which I think we need to follow up on. We hope that you will allow us to engage with you and your team to do that in the follow-up to this meeting.
Absolutely, thank you.
So thank you very much, Jay. It's a lot of meat to that, and if you can share with us any written comments you might have, it'd be very helpful for the UN Capital Development Fund to move forward along with its partners and co-sponsors. So thank you, and please stay with us if you will, to listen to others if you have time. I would like to now turn to another co-sponsor of this conference, Achim Steiner, the administrator of UNDP, which is where I started my career many years ago, who will speak about the importance of standards, metrics, and partnerships to enhance investor confidence and the integrity of green and SDG bonds. May I call upon Achim to join us, please?
Thank you, Mahesh, and I'm glad to hear that the career didn't end with UNDP, so clearly congratulations on what came next. And let me also begin by extending my warm greetings to His Excellency, the Vice President of Malawi, Saulos Chilima, my colleagues, Preeti Sinha and Yannick Glenmarek, with whom we are together organizing today's session. And I think we're all in agreement that we find ourselves truly in the midst of a perfect storm, which is further exacerbating the challenges developing countries, but especially LDCs, are facing to finance in the broader context, both the response to many of these shocks that are affecting economies, but also how to invest in a way forward. We do need to find more durable solutions to facilitate their access to affordable finance, to advance the SDGs. The recent expansion of green, social, and sustainability bonds, and Jay, was very interesting to listen to you also just now, is promising. And though still a small portion, as you all know, of the overall bond market, their growth does create an opportunity to leverage private capital for sustainable development at scale. That really is the challenge of our time. And given the size of national budgets and responsibilities for resource allocation, governments have the capacity to bring scale to sustainability bond markets by issuing sovereign bonds to finance development priorities, and many are increasingly taking up the opportunity to do so. By the end of 2020, governments around the world had issued sovereign sustainability bonds for a value of approximately $96 billion. And sovereign sustainability bonds have the potential to transform markets. Their benefits, as you all know, range from increased transparency through budget tagging exercises, reporting and verification mechanisms inherent to the bond, to increasing investor participation, access to a more diversified investor base. The importance of the latter cannot be underestimated, especially in developing countries and LDCs contexts. But few developing countries are able to participate in sustainable debt markets, and LDCs are particularly disadvantaged. Speakers before me have alluded to some of the many barriers they face: inadequate use of credit enhancement mechanisms, including guarantees to de-risk green bonds, weak local market infrastructure with thin capital financial markets and legal frameworks, limited capacity of and guidance for governments and local authorities to issue sustainability bonds, and perceived and real risks, including creditworthiness risks, which increase costs exponentially for many LDCs. UNDP is currently extending support and policy advice to over 35 countries, including several LDCs such as Cambodia, Laos, PDR, Rwanda, Senegal, and Tanzania, to address some of these barriers. We are learning together. Our assistance is mainly focused on advisory services to governments to establish the infrastructure to issue and report on SDG-aligned bonds. Current trends such as climate change, the growing sense of vulnerability created by the COVID-19 pandemic, increasing inequality, biodiversity loss, among others, are bringing us closer to tipping points where addressing sustainability in a holistic manner is increasingly important to manage risks. Markets are rewarding that to some extent. Heightened awareness about these risks, in particular those associated to climate change, explains also the increasing interest seen by private investors and businesses in sustainability and reflected in the growth of the sustainability bond market. However, the lack of common or shared standards and methodologies to identify a pipeline of green or sustainable labeled projects, which can be used to define performance metrics and measure, verify and report on results, remains an important limiting factor to market growth. The lack of clear definitions and differences in concepts currently in use leads to uncertainty, affects market transparency, creates opportunities for greenwashing, undermining the integrity of sustainability efforts. It is essential that the increasing interest by all actors, including private investors and businesses, in embracing sustainability be guided towards genuine SDG impact. UNDP set itself to address this with its SDG impact standards, which offer universal guidance to organizations, businesses, enterprises on best practice for decision-making on their contributions to the SDGs. The SDG impact standards, developed over a period of 2.5 years, lead to more robust practices, including on the choice of specific performance metrics within available alternatives. Impact standards for private equity, enterprises, and bond issuers are available and are being used by market actors. In Bolivia, for example, the UNDP is working with the Productive Development Bank in the issuance of sustainability bonds, assisting with the formulation of a development framework to guide the use of proceeds, integrating the principles of the International Capital Market Association and UNDP's SDG impact standards for bonds. With our support, also Mexico became the first country in the world to issue a sovereign SDG bond and issued a second emission of a 15-year SDG sovereign bond for a total value of 1.25 billion euros in 2021. And with the GISD Alliance, UNDP made more than 350 SDG-aligned investment opportunities in 17 countries available to investors in least developed countries like Djibouti, Rwanda, and Namibia. It is one of our commitments to particularly help countries who are not on the highway of global investors to be both recognized for the opportunities they offer, but also for ways in which these can be realized. These are taken further with the identification of project pipelines across countries such as Colombia and Ghana, which can be used for financing from debt instruments such as sustainability bonds. Let me close by saying that throughout our work on enabling sustainable finance in developing countries, partnerships are fundamental and play a critical role. Our collaboration with the UN Capital Development Fund in this context is of central importance. UNDP and UNCDF work together to expand the scope and breadth of services around debt issuances, notably on municipal bonds targeting LDCs. The complementary capacities of the two UN agencies enable countries to access a deep bench of experts on identifying and executing debt solutions tied to delivering the SDGs that are not elsewhere available, or at least not easily. Jointly with Citibank, we have organized workshops on sovereign SDG bonds for national stakeholders in Africa, starting with pilots in Senegal, Cameroon, and Gabon. And with our co-host, the Green Climate Fund, we are also working in dozens of countries on solutions that are meant to combine public and private investment potential. So let me end by saying that to achieve the SDGs, we need an international financial system that works for all countries, and it clearly is not. And this was also very much on evidence again last week at the spring meetings, where the world is struggling to respond not only to those who are central to the global financial system, but also to those for whom the financial system is central to what happens next to them. This needs to be combined with scaling up innovations and new financing instruments and approaches such as sustainability bonds. Many developing countries need support to build capacities to maximize these opportunities. In UNDP, we are firmly committed to assisting our member states in achieving the 2030 agenda. It is the roadmap out of the confluence of crises we currently face, and to playing therefore a key role in moving the financing for development agenda forward and beyond the traditional constraints that so often have left developing countries and LDCs in particular at a disadvantage. Your Excellency, dear colleagues, it's been a great privilege to join you, and I have very much enjoyed listening also to the contributions already made. And with that, Mahesh, back to you. Thank you.
Thank you very much, Akim. I congratulate the UNDP on the exemplary work you're doing to facilitate confidence in the green bond and the climate finance markets through the enshrinement of standards and the capacity building on and using those standards and promoting the use of such climate bonds with Citibank and others. I think that's very important work, and I'm delighted you're doing that. Hopefully you will continue to pursue that further. With that, we have finished the first part of the program today. We have seen the challenges. The Honorable Vice President of Malawi put us to task in trying to address the large volume of financing that is needed for climate mitigation and adaptation, and the challenges and steps that we should take. Others have spoken to the roles of the UN Capital Development Fund and UNDP, the Green Capital Fund, as well as the capital markets and the banking markets. We have the challenges of converting, to the extent possible, to higher volume of financing that Jay talked about, that investment grade markets provide through enhancement that unfortunately non-investment grade markets do not have. That's a challenge that we must try to meet with potentially the kinds of guarantee companies that the Green Capital Fund is trying to promote. We hope that that is pursued further. With that, I'd like to now turn to the issue of the panel that is following. We have a very distinguished panel of speakers that will be addressing some of the barriers and the action steps. Among them are Charles Waja, the Commissioner for Financial Sector Development of the Ministry of Finance and Planning in Tanzania. We have also Antti-Pekka Karhunen, who is Director of the Sustainable Finance Area of the European Commission. We have Marie Biron, Managing Director of the Sovereign and Subnational Risk Area and Ratings at Moody's. And we have Ed Parker, who has a corresponding position at Fitch Ratings, being the head of sovereign and subnational, sub-sovereign risk, supranational risk at Fitch. and the head of research. So let me turn first to Dr. Charles Wanwaja from the Tanzania government. Your Honor, please, if you're online, the floor is yours.
Yes, I'm online. Well, thank you very much, everybody. I recognize the presence of everyone, including the Vice President of Malawi and some other colleagues. Well, I'm Charles from the United Republic of Tanzania, where I work as the Commissioner for the Financial Sector Development. And the financial sector development is a little bit wide. We are responsible for resource mobilization issues related to a number of some other important stakeholders, including banks, social security, insurance, and others. Well, first of all, I would like to talk about the path that we are pursuing toward alternative project financing as far as sustainable financing is concerned. Well, as a country, we have the 5-year development plan, in which is a policy documents that tends to guide the planning of the nation for the next 5 years. The plan which we are implementing now is the third in the row. We just finished implementing the second one, and now we are implementing the third 5-year development plan. And in the plan, you will find that there is a very big requirement for financial resources. For example, in the projections which we have put, we are planning to mobilize resources to the tune of about 110 Tanzanian trillion shillings. And out of that, we anticipate, we are projecting to raise about 40 trillion Tanzanian shillings from the private sector. So you'll find that there is a lot which we need to do as a country. And because of that, we had to prepare a financing strategy on trying to see how best we can mobilize that resources. And in line with that, we had to prepare the financial sector development master plan, in which we had also indicated long-term development finance as an important area to pursue as a country. And parallel to that, we had to prepare a separate strategy, which we call the Alternative Project Financing Strategy, the APF. The APF is a recently launched document, which is now trying to focus on alternative means through which the government can use to complement the implementation of development projects in the country. Now, when we were preparing this APF, that basically encompasses different versions of alternative or innovative financing for that matter, we had to take on board the participation of different stakeholders in the financial sector. So as a country, we have embraced that, and there is a very high political commitment to try to tap on some other opportunities that the financial sector can provide. And when you read that document, you'll find that we are planning to be issuing a number of instruments, including bonds of various types, the green bonds, the blue bonds. We are also talking of infrastructure bonds, green financing, and some other instruments. So that is the path which we are currently pursuing. And as a country, we have just formed a special facilitation team that will be assisting ministries and the departments of the government, as well as local government authorities, in trying to come up with bankable projects. Yeah, what we are learning here is that from the experiences which we have had in the past, most of these government agencies were, I can say, were used to receiving funds from the normal government budget. And because of that, they were not used really to prepare the bankable projects to the levels that will be acceptable to the different providers of funds. So we are finding that there is a very big room which we need to work. There is a very big work which we need to do in terms of building capacity so that these departments of the government are now able to produce the bankable projects. But another thing is in terms of the legal and the regulatory frameworks that we have in place in Tanzania, we are finding it that the current structures can accommodate issuance of different debt instruments, except for just for some other areas that probably we might need to improve some legal and regulatory frameworks. And these included issues related to crowdfunding. But otherwise, for the nation here, we are finding that it is really very important to pursue the possibilities of exploring these innovative financing opportunities, because we are finding them to be much more important, one. But second is, it will also assist the government to concentrate on some other areas that probably might not be attracting the private sector very much at the moment. So this is very useful, and we are working very much closely with a number of UN agencies, including UNDP and UNCDF, because currently we are also planning to go for the issuance of municipal revenue bonds, but also some other infrastructure bonds as well. So maybe I can share that currently, but I think I'll be able to explain as and when needed. But all in all is that innovative financing is a very, very important tool, especially for emerging countries like Tanzania, that have traditionally, for a number of countries, have been using the traditional ways of budget financing, while out there are a number of opportunities that can be used. So we are well geared and organized, except that we need to address just those challenges which I have highlighted. Thank you very much, and back to you, moderator.
Thank you very much, Honorable Minister. That was very extensive discussion of the infrastructure in Tanzania for planning and implementing financing of development, including climate financing. We hope that you can move forward with the plans that you have in place, and that you can call upon partners around the table for assistance as necessary. May I turn now to our next speaker, who is Antti-Pekka Karhunen, Director of Sustainable Finance Investments and related to jobs, economy, and the markets that work for the people from the European Commission. Perhaps you can share EU's efforts in supporting LDCs and developing countries address climate changes and leverage the potential of green finance.
Well, thank you very, very much, and excellencies, colleagues, and dear friends. I would really, first of all, like to thank the organizers for inviting me to participate in this important event. And the European Commission is really putting and has put the transitioning to green and climate resilient global economy on the top of its agenda. And we are here very keen to work with you on how to mobilize sustainable finance for our partner countries who continue to have an insufficient access to affordable finance. So it's an honor for us to be part of this important discussion. Mobilizing public and private capital for our partner countries will really be crucial to collectively deliver on the sustainable development goals. Indeed, the challenges are known. Many of the speakers have already mentioned them. The COVID pandemic has had its global economic fallout already. The climate change is already had a dramatic impact. And now Russia's unprovoked and unjustified invasion of Ukraine has exacerbated many of the pre-existing development challenges and added inflationary pressures that risk becoming very serious. So it's a pretty grim picture today. However, a lot is already ongoing to address many of these difficulties. And just to give you a teaser, we launched yesterday our quite extensive Investing in Sustainable Finance Development report, from which you can see a picture of how much the EU and its member states are supporting partner countries on financing their sustainable development objectives from various sources. And we are also stepping up our efforts further. With our Global Gateway initiative, the EU is and has set out concrete ideas for green, smart, and inclusive investment and sustainable and high quality infrastructure development. Global Gateway fosters the twin transition globally and covers links to digital, energy, and transport sectors. And it also strengthens health, education, and research systems around the world. With the Global Gateway, we aim to mobilize up to 300 billion euro between 2021 and 2027 for a lasting global sustainable recovery by mobilizing at scale the private sector. Well, indeed, there is more than enough capital in the world to help access the global financing gap. We believe that sustainable finance can really play a key role to bridge this gap and to achieve the objectives of what we have set ourselves in the Global Gateway and which are there for all of us. And to support our partner countries in financing their NDCs. Yet scaling up sustainable finance globally is a challenging thing, and even more so in the low and in the middle income countries. So how can we do this? And we would say by addressing three different fronts. Firstly, by supporting partner countries in building a conducive sustainable investment climate. So this is about developing credible and coherent sustainable finance frameworks. It's essential to provide transparent and reliable information for investors to seek truly sustainable investment opportunities. So here we stand ready to share our EU experience and work with our partners to identify the most suitable solutions at country level. Secondly, by providing public support through, for instance, guarantees and blended finance instruments. With these, we want to catalyze private capital and in those markets where the risk is perceived to be too high by investors. And our European budgetary guarantees under the what we call the European Fund for Sustainable Development Plus will play an important role here. We are working very closely here with the DFIs. And third, we really like to stimulate the uptake of sustainability related financial instruments, and in particularly we are talking of green bonds. These can play a key role in mobilizing private capital towards sustainable investments, and indeed we do agree that they can be a game changer, as has been already mentioned. What we want to do is to work on increasing investor confidence here. We are convinced that sustainable finance instruments have a higher potential on that what has been currently exploited, and it's very encouraging to hear also these examples that Mr. Steiner has put forward. To support concretely our partner countries, the EU is working on a number of very concrete initiatives. Allow me to just briefly mention three. Firstly, we are working on a strategy to accelerate the flows of private capital towards sustainable investments in low and middle income countries. This is something that we'd like to publish next year. And to this end, the European Commission is now setting up a high-level expert group to provide recommendations on transformative actions to scale up sustainable finance. And there is a call for proposals for joining this expert group, which is out now and has been published and is open until the 11th of May. The second element is that the Commission is providing technical assistance and capacity building to partners in sustainable finance area. So here we support countries in developing these credible frameworks, taxonomies, but also developing pipelines of green and bankable projects and fostering linkages between local projects, entrepreneurs, and global investors. And third element, we are committed to support our partner countries in developing and scaling up their green bond markets, for instance, through what we call a global green bond initiative, which we are developing and which we have announced in the recent African Union, European Union summit. For all these efforts to succeed, it will be really crucial to work together to develop coordinated approaches, coherent frameworks, and tools that will then enable our partners to fully benefit from the potential that sustainable finance can offer. And as Mr. Steiner said, partnerships in this area are really, really fundamental. So just to finish, we really look forward to continued and joint efforts in this exciting and crucially important field of cooperation to be able to deliver on our universal goals on an inclusive, green and sustainable manner. So thank you very, very much.
Director Karhunen of the European Commission for very concrete discussion of the challenges and the steps that you are taking, including the expertise that you are soliciting on scaling up. I think that's very important, and we hope that you're able to generate good ideas on how to scale up and assist countries to do so through the initiatives that you have mentioned. I would like to now turn to the two rating agencies. We have heard from Jay Collins that to scale up the volume of financing, among the many different things required, there needs to be investment grade rating for the financings where the volumes of committed capital are substantially larger than they are for non-investment grade capital. These are difficult to attain, and perhaps we can hear from Marie Durand, who is Managing Director of Sovereign and Sovereign Risk at Moody's. What are the challenges in looking at climate risk, in looking in doing their ratings for countries, and how can Moody's factor in? How does it factor in climate risk in looking at sovereign ratings, and whether they limit the ratings of countries to non-investment grade, and how they can be upgraded if the countries try harder with the investments of the kind we have been discussing. Those questions go to both Marie and Duane. First, Marie, please, the floor is yours.
Thank you, Mahesh. Thank you for inviting us to present today. I was really interested hearing from all the distinguished speakers. And I think I noted really a number of points, which I will echo in explaining how we look as a rating agency, as Moody's, how we look at climate risk for sovereigns, as you explained. Essentially, it is an assessment that is formed of three parts. So, and I'll cover the three parts in some detail with some examples in the time we have. The first part is the exposure to risk, which is science-based, and I'll explain how we get that. The second part then is the adaptation capacity. How sovereigns, given that exposure, how sovereigns can adapt. And the third part, which many have of the speakers today have discussed at length is the financing of that adaptation, and again the credit implications that the particular choice of financing may or may not have. On the exposure, as I said, this is science-based, and we benefit at Moody's from the expertise of Moody's ESG solution. It's part of the group where there is a team that runs climate models that give us, as rating analysts, sovereign rating analysts, a view about each sovereign, each countries, and including also regions and at a fine level of detail, exposure to the various natural hazards that are likely to get to become more severe and more frequent with climate change. So from that, we get a view, for instance, of Tanzania's exposure for the many decades ahead to, say, flood risks, which seems to be is one of the risks that we identify, heat stress, rising sea levels in for some countries, and so on and so forth. That clearly sovereigns cannot do. That is largely determined by geography, topography, and of course by carbon emissions globally. So that is not something that the sovereigns themselves can do much about, but it is an important part of the determination of the risks. Where sovereigns can then intervene is on the resilience aspect, and that resilience takes many forms. So we look at firstly the composition of the economy, because some sectors are more vulnerable to climate change. What we find is that sovereigns in sub-Saharan Africa with a relatively substantial part of the economy in agriculture, for instance, tend to be more susceptible. Similarly, when we look at islands in the Caribbean or Pacific, then it is the reliance on tourism that heightens that sustainability. But there's other aspects where the policy and what Mr. Kahunen mentioned in terms of really active policy can come in. First, it's really building then more resilient infrastructure that will stand the country and the population in good stead to face natural disasters, as well as a resilient and really high quality care healthcare sector, which is essential in the recovery period. We've seen that time and again. So to assess that, we look at overall adaptation capacity, the track record that we have of the country's capacity to adapt to shocks or changing trends. And there, what we find is that the sovereigns that are more exposed to physical climate risks, to climate change, as per these climate models, tend to have a lower adaptation capacity in general, and that we measure, and we think they are relevant metrics in terms of looking at income levels, looking at government's debt burden, looking at the overall rating. So what we find is that the sovereigns that are exposed to physical climate risk tend to have lower income levels, tend to have a higher debt burden, and tend to have a lower rating. But that is why we are really, because this is a relatively broad picture, we are really interested in understanding the government's particular climate adaptation plans. And we are really engaging with sovereigns, all the sovereigns we rate on that, and planning to engage increasingly, because we think it is really important to understand what the plans are, how effective they are likely to be. So far, what we have are examples of particular projects, and I'll name a few that have caught my attention because they address some of the broad questions. So one example is in Kenya, where there's been for a few years now a actions plan to devolve climate finance to allow local governments to decide how to invest the funds. The effects of that evolution are starting to come through. And what is noted, and this is noted by international experts, which really we take the research from. So increased water availability, food security, cleaner water supply, and fewer lower levels of livestock death. So really a wide range of effects that seem to be coming related to that decision to devolve the decisions at a local level. That's interesting, that devolution decision is interesting because we are keen to understand when a country forms its climate adaptation plan, how the plan will be implemented at a central level, at a local level, what coordination there will be between different parts of the administration, what course correction maybe there will be as the plan evolves and that climate evolves to ensure full effectiveness. Another example that I mentioned is in Senegal, quite a different project that is already 10 years in the running. So a project with a track record that's starting to come through that is focused on mitigating coastal erosion. Here I thought that example was really interesting because it echoes something that we see, that an issue that is environmental at the origin, coastal erosion, quickly brings in social aspects as well as governance aspects. And here are the objectives of this environmental, protecting the country's coast, but as well, then through that, protecting the livelihoods of fishermen, of rice farmers, and fostering, attracting, and private sector investment. So you see how the whole ESG piece quickly comes through. In terms of financing, and I'll finish on that, I think a lot has been said already. We, as a rating agency, of course, are agnostic in terms of really the sources of financing. What we look at are the credit implications of particular financing choices. So far, it seems quite clear that financing will need to come from a wide range of sources. So the multilateral development banks have a key role to play and play a key role. So far, the amounts that we see put towards climate adaptation are relatively small in comparison to the estimates of the needs. So that's where private financing comes through. And we are looking and taking into account credit enhancements where particular financing structures allow that. We have recently published a piece of research with, again, quoting a range of examples that my colleagues in the project infrastructure group have rated of transactions with particular credit enhancements, from partial to full guarantees, as well as various forms of insurance. So that is an important aspect. And then, of course, the green, sustainable, blue bonds, the various label bonds, which from what we see, allow issuers to really articulate that climate adaptation plan. And we, I think, know all very well that markets do like and do ask for transparency. And so through particular issuances, I think there's an opportunity there for sovereigns to explain their plan, to explain their story and the credibility of their plans, and that's very important. Thank you.
Very good. Thank you very much, Marie. That's very helpful to know how you look at in issues of climate risk, how you found some interesting examples to cite in Kenya and in Senegal, and how the markets can look at how you evaluate credit enhanced structures, especially your report that you mentioned. Please share it with us, and we will circulate it to these attendees so that this gets wider dissemination. As Jade mentioned, much of the work on this kind of financing is a la carte, and so we need to find a way to scale things up, and disseminating your methodologies and methods of scaling or you replicating would be very helpful. So please do that. With that, we would like to turn now to Ed Parker. You are the last, and you therefore have the ability to say anything you want, but in particular, do say things about the ratings and the climate risks that are embedded or assessed as a part of that process, and any particular lessons that or examples that you can cite in what you do, which is globally focused for sovereign and supranational ratings, how you look at these issues and how you can comment on the discussion so far.
Yeah, well, sure, and thank you very much for inviting me to this excellent conference. It's great to be able to take part. I'd like to respond to a few of the comments I've heard and as you say, explain a bit more about ratings in this context. And I think it's clear everyone agrees that climate change will give rise to additional financing needs for low-income countries to meet both mitigation and adaptation costs. And given that unfortunately many lower income countries are relatively exposed to climate change, those costs are even greater than for developed markets. And I think another point which I haven't heard so much today, though, is that every dollar invested in low-income countries should generate higher environmental returns for the global effort to counter climate change because of lower energy efficiency per unit of GDP and other factors. So I think that just emphasised that this is very much a global initiative and incentives for all countries to contribute. I think another important point that others have made is that many low-income countries are unfortunately already struggling, particularly in this very challenging global environment, under a high weight of debt. So more debt inflows to provide financing for climate change carries the risk of increasing risk to debt sustainability and increasing restructuring risk. So I think that just emphasizes the value of the conversation that we've been having about looking at some of the additional instruments and sources of financing that might be available, which ECHO would include grant financing, equity participation, highly concessional loans, and potentially more innovative instruments, not necessarily just pure vanilla debt instruments that will add to these high debt burdens. And as a rating agency, we do we have criteria that allows us to rate many of these instruments, guarantees, partially guaranteed bonds. We rate green bonds, and also potentially climate-related debt instruments is something that I think we should be able to rate under, depending on the specifics of those instruments and certain conditions. I would also like to make a couple of comments in response to some of the conversation going on in the chat, that our criteria is freely available on our public website. We are transparent about our criteria. There are no secrets here. And credit rating agencies are already highly regulated institutions. We also have the same, for sovereigns, we have the same rating criteria, and we have the same rating model for all sovereigns, emerging markets and developed markets. We don't treat any countries differently. It's exactly the same approach that we take. And then just to come back to the question of green bonds or sustainability bonds, because that's been a key topic of our conversation. I think an important point here is that if they have the same obligor, they're identified as pari passu with conventional bonds and are serviced out of the same financing sources as conventional bonds, as is typically the case, then we would expect to rate them at the same level as conventional bonds. So, in that sense, we would see green and sustainability bonds as, adding further to debt burdens facing countries. And, I think that also sort of plays into the related point is that in terms of the public finances, and many components of the public finances are essentially fungible. If a project has a high rate of economic return, or it's worth doing for social or political reasons, then it can be financed from many different sources: taxation, other revenue sources, green bonds, other sorts of financing. So, green bonds is not necessarily a magic solution to providing financing in a way that doesn't, that wouldn't have implications for debt sustainability issues. In terms of climate risk, well, I think we're probably, I see we already run past time, so I don't want to repeat many of the points that my colleague at Moody's has made, but we do expect climate risk to become an increasingly important part of sovereign ratings as these impacts become greater as climate change intensifies over time. But let me leave it there.
Thank you very much, Ed, and I'd like to extend the sponsors' thanks to you for sort of stepping up to the plate at the last minute, having just seen each other recently in Washington at the spring meeting. So thank you for stepping forward, and I'm glad we could accommodate you. Thanks also for pointing out the importance of non-debt capital financing for climate. It's very important to bear in mind that while you fix one problem, you don't create another one. So if you raise debt to fix climate, you might increase debt financing and financing for climate, but you might reduce your ratings. That's a risk that you got to watch for. So let me just say that this has been a very rich discussion. It's impossible to summarize everything. It's a rather impressive list of problems and challenges and action steps that have been suggested. I would just like to thank all our speakers today for an extremely rich discussion. We hope that we'll summarize this with some kind of way forward, but I will just mention a few things that appear fairly clear for the next steps. First, the support to improve domestic investment environment and enhance capital market access via attractive credit ratings. The devolution mentioned by Marie Diron was interesting, that devolving power and financing to local authorities actually help accelerate reform and action on climate. Second, identify, measure, and report on the pipeline of bankable climate investment projects. This is where the Tanzanian minister said also that some of the projects that are prepared for the Ministry of Finance to fund are not necessarily at the standards required by other funders. So increasing capacity to fund at the local level through better measures to identify the pipeline and make them bankable is very important. Third is to design and scale up innovative financial instruments. And this is where I think this has been the most interesting discussion to me. My background is in capital markets and in innovation. I actually founded the first non-US financial guarantee company that brought deals to investment grade from non-investment grade, which I think is what we need again today. So thank you, Jay Collins, for pointing that out. And I hope that you'll succeed with the multilateral development banks and scaling them up and leveraging them up, perhaps with a lower rating than AAA. Very interesting idea there too. Third, the other design solutions have been mentioned. The one by Yannick from the Global Green Capital Fund on the guarantee company, very promising. And from the European Union regarding expertise on how to scale up. I hope experts around the table and those attending on Zoom will chime in and join their proposals to join the EU and helping them move forward. And fourth and finally, the strengthening of domestic financial systems and institutions, as well as international investors, to incorporate climate risk and opportunities into investment decision-making. As you know, there's a lot of financial innovation taking place. We didn't talk about the risks related to that. There are risks, but there are also opportunities, and climate offers great opportunities. Jay Collins especially, I go back to the gap that you mentioned, Honorable Minister, of how much financing, Mr. Vice President, how much financing is required. And Jay Collins mentioned 47 billion sitting out there, trillion sitting out there waiting to invest. we're to find a way to bridge the investors' risk appetite with the opportunities that exist in climate finance. With that, let me thank you, and let me see if Preeti Sinha, you want any concluding comments as a co-host.
Thank you, Mahesh, and thank you to all participants. I would really take this moment to reaffirm our commitment largely to the member states, to the people of the member states, and really to galvanize the ecosystem that we brought forward here to the benefit of investing in the people and leaving no one behind. So as UNCDF, we really believe in the power of both capital and development, all pathways leading towards the people. So please stay with us as we continue this journey in collaboration and partnership with the countries. And we hope that we will be able to see solutions, and really the capital markets will work differently in the future, adding much more of the development angles so that capital can serve humanity. Thank you.
And capital has to serve people, not the other way around.